So the first thing I wanted to talk about is rates. And rates are interesting here for a couple of reasons. One is that they've been going up. That's just the reality. And the question is, should they be going up? And how much higher can they go? Or are they more probabilistically going to go down from here? And to answer that question, we put together a chart. It's actually a chart that we've had for a number of years, but I think it's probably the first time we're showing it on this segment. And I think it's really helpful in helping people to actually understand why rates do what they do in this sort of post-crisis environment, and how to sort of use this framework for thinking about what they're likely to do going forward. So there's a chart up right now. I'll walk you through it. It's a little bit complicated. There's a lot going on there, but allow me to spend a couple minutes here explaining what the heck is going on. So after the financial crisis, the Fed basically rolled out its quantitative easing programs. To date, there have been 3 de facto quantitative easing rounds. There have been a few other things thrown in there with Operation Twist and so forth, but for simplicity's sake, we'll limit it to QE1, QE2, QE3. So what happens during quantitative easing? Well, the Fed goes out into the market and buys Treasury and agency mortgage-backed securities, anywhere from several hundred billion up into the trillions. They've done this 3 different times over the last 5 years. And what's really interesting about when they get into the market and buy securities is that it actually ends up having the exact opposite effect of what common sense would tell you. So what do I mean? Well, think about any security. If you introduce a giant buyer, and the Fed is a giant buyer, into an asset class, what should normally happen to the price of that security? The price should go up. But in fact, what happens is when the Fed gets into the securities market for treasuries and agencies through QE operations, the price goes down. And that's why yields go up. And if you look at that chart, what you see is during QE1, during QE2, during QE3, 10-year treasury yields actually move straight up. And then the opposite holds true. When they stop QE rounds, yields come straight down. This completely defies what sort of common sense would dictate. But once you understand this, then you can really start to have a framework for thinking about rates. And the point that we would make is that the Fed began tapering their purchases quite a while back. They're now completely out of the market. They have been for some time. And you really have to use this sort of modern playbook, which is the post-crisis environment. What do rates do under what circumstances? And everything we've seen from 2008 to present is that when the Fed is out of the market, the probabilistic tendency of rates is that they come down. This is a very consistent pattern. And so, while in the short term,
do you just assume that is true, or do you have a view on why that happens?
Yeah. So the fundamental underpinning for why this is the case is that there's sort of 2 arguments. One is fear, and the other is deflation. So the idea is that when the Fed is going, so I'll answer the second one first, on the inflation deflation point. When the Fed's in there buying securities, the argument is that it's inflationary. And so obviously we know what that does. Conversely, when the Fed's out of the market, people get nervous, right? So this is why, in fact, even though the Fed is a large buyer and you'd expect the price to go up, in fact, the price goes down because people leave the asset class in search of better returns. And so it's a perfectly reasonable underpinning, even though on its face it's a little bit counterintuitive. And so, the point I would make is we're sort of seeing, so this is the bigger picture framework for rates. And right now we're seeing essentially a counter trend move. We've been seeing rates move higher. Well, why? The why is because Europe is now very much in the same QE game. The same rules apply to them, meaning that when they are in the market, rates go up. right? And as a result, right, you have natural purchasing power parity dynamics that are going to interlink global rates and so forth. So if their rates are going up, it's going to create a little bit of upward lift on our rate environment. But the reality is that there's always reflexivity. And so if our rates are going up, the concern is that that's going to start to slow the economy, right? And one of the areas that I focus on is housing. And this is probably the single biggest concern when I talk to investors. Well, what if rates go up?
What's the curve going to do?
Yeah. And to shift gears for a minute and talk about that, since it is sort of the elephant in the room on housing, I would make a couple points. One is that, first of all, in order to actually see any real move in housing as a fundamental asset class, you'd need to be talking about something much larger than what is currently in the market. If you go back over the last 25 years, there's been a couple instances, 3 in fact, when rates have moved over 125 basis points in under 18 months. So we're talking about obviously a tiny fraction of that kind of move. And what's more is that, like, if you just go back to the last cycle, the Fed from mid-2004 to mid-2006, they came in and raised rates 17 consecutive times, right? So the Fed funds rate went from 1 to 5.25. What happened to mortgage rates during that time frame? That's the actual transmission mechanism, right? Mortgage rates started that period in mid-04 at around 6%. 2 years later, by mid-06, they were at 6%. There was about 100 basis points of volatility up and down along that 2-year path. But the reality is
they stayed flat.
Yeah. So, the point I would make is that, and I think one of the points that we make from a macro standpoint quite often, which is exactly the right point, is that even if the Fed does go 25, 50 basis points, let's say over the next year, the reality is at the long end of the curve, you're not likely to see much transmission. And remember that, again, it's reflexive. So if the long end of the curve starts to come up, growth concerns will start to elevate, and that will push the long end of the curve back down, right? So, and think about it. We're at
the fear pushes money back in the Treasury.
We're already at near full employment, if not full employment, and so you've got an environment from a labor market standpoint that's about as conducive as it's going to get, and yet you're seeing long end rates doing very, very little. In other words, what's your asymmetric setup? Is it more probabilistic that things are going to go down or up? I think it's pretty obvious, right? So anyway, that's sort of the number one concern on the housing side. I'm very much in the flattening camp, because if the Fed does in fact come out and raise rates, the most concerning thing for people is going to be that this is going to slow growth.
Yeah.
A lot of people talk, it's a double-edged sword. People say, oh, well, if the Fed raises rates, it's only because the economy is so strong. Well, that's true up until the point when they do raise rates. And then all of a sudden, once they raise rates, people say, well, they just raised rates. That's going to slow growth.
How much is the equity market behind this move? Because if there's a big drawdown in the equity market, isn't that going to that's going to push the curve flatter, right?
Yeah, I think the equity market is interesting. There's a pretty famous investor who wrote a very interesting article maybe 3 years ago now called something along the lines of Fed and jelly donuts.
Yeah, I remember that.
Yeah, and the idea was that one jelly donut tastes great, 2 jelly donuts are okay, but like 13 jelly donuts and you've got like a real problem. And the idea is that the Fed needs eventually to sort of be weaned off QE here. But the point of the article was that their main indicator for what to do is the market. And this is when Bernanke was in the seat. And the argument was that, this is a number of years ago, but there was a rogue trader at SocGen who, there was a big scandal coming out over the weekend that he had lost them something on the order of $3 or $4 billion. And Bernanke basically called around to ask different heads of trading desks, how bad is it going to be? So in other words, he went and cut rates 50 basis points before he even saw the market open. In other words, his main concern was, what's the stock market going to do? So, the Fed puts inflation and employment out there as their two primary mandates, and they're data-driven and so forth. And, for all intents and purposes, I think that is obviously a big factor in their model. But the reality is that they rely very heavily on what the equity market is doing. And I think if you look at the equity market,
so they're probably somewhat scared about that then, right? The risk of raising rates, even if who knows if it really should matter, I guess.
Yeah, I think the two things that sort of augur for a rate hike, one is that the market continues to act reasonably well, and the second is that the housing market is really sort of, particularly versus last year, showing extremely good signs of life here in 2015. It's one of the reasons that we're very bullish on it. So the point is that you can paint a lot of different scenarios here about where rates can go, but at the end of the day, I think what you really need to be thinking about is when the Fed starts to raise rates, is that going to make people feel better or worse about prospective growth? And I would argue that people will get nervous. This is exactly why over the last 7 years, every time the Fed comes out of the market from a QE standpoint, rates have gone down, right? So to me, it's no different. I think that's why now with rates sort of up on a rope here, housing looks extremely compelling on the long side. We got the jobless claims number this morning. That number basically little changed week over week.
Sure, that trend continues.
Look, the big picture with claims is that we've gone and looked at the last 3 cycles, and claims tend to hit a frictional floor around 300,000 to 330,000 in weekly initial claims filings. We've been there now for a little over 10 months. And if you look historically at the average of the last 3 cycles, it's a small sample, but that takes you back about 25 years, 30 years. The data would argue that there's about another 18 to 24 months before the labor market really starts to fall apart. What catalyzes that? Well, it's credit, right? The credit cycle. And how do you track that? Well, you look at the Senior Loan Officer Survey. So one of the things that I would flag is that in the most recent Senior Loan Officer Survey, which came out about a month ago, one of the things we watch is the willingness to make C&I loans, demand for C&I loans. Are you tightening spreads? Are you seeing greater demand and so forth? If you go back and look at all the prior cycles, C&I, Senior Loan Officer Survey responses have always led the cycle by quite a bit. And what's interesting about them is they tend to, they're very cyclical, right? So they kind of follow these defined patterns. And we're well past here, and we're now here.
In terms of the extension of.
Yeah, so it's basically a diffusion index. It's, they ask a bunch of loan officers, are you tightening standards? Are you increasing spreads when you're making loans? Are you seeing increased demand for these loans across different asset classes? So C&I, commercial real estate, auto, mortgage, credit card, et cetera. And what you see on the C&I survey, it's a very good indicator, is that these things, so for a while, credit standards are on the margin easing, and then they start to go the other way. And once they start to go the other way, they tend, the data is very autocorrelated, so it kind of trends in the same direction for a long period of time. And so it started to go like this. It hasn't yet sort of converged back to zero, but it's extremely close. Like the net percentage of loan officers who are still easing standards is just barely above net zero and falling. So that on the margin has me a little bit nervous because if credit starts to contract, right? That's obviously an enormous problem.
So you have the right. So if credit starts to contract, you figure that's probably a consumer spending issue, and then if the central banks continue to be in the market and rates are pushed to zero, and then they almost lose the ability to to ease or whatever you want to call it. I mean, that's probably when a real problem persists, right? Because since the mid '80s, every interest rate cycle has come to new lows. It seems like that's happening again. And if you have the credit on the credit side, if you have that rolling over, it seems like the next several years it presents a real problem.
Yeah, I mean, this comes back to the velocity of money argument and this idea of sort of pushing on a string, and you can cut rates to zero, but you can't get people to borrow and so forth. So what do? Well, the only thing left to do is go print money, force investors out of the safety of treasuries and agencies into the stock market, into the housing market, try and create some wealth effect that actually, a lot of it's animal spirits, right? So you're trying to push out this sort of general sense of confidence that prompts people to go out and spend money.
Yeah.
And so that's essentially the playbook. And now what they're trying to do is restore sort of the old order, if you will, where we can sort of finally lift off of zero, get arguably back to a point where rates are 50 or 75 or 100 basis points, something like that, so that when inevitably the next cycle does roll over, they have something.
Some room to cut.
It's not immediately go to QE4. There's a little bit of gap there. So, that's basically the setup on rates as I see it. And housing is the reason we like housing primarily is because most of the market, especially most of the financials, are very late cycle at this point, right? We've been in this expansion now for 6 going on 7 years. By all accounts, whether it's the credit cycle is measured by the Senior Loan Officer Survey, the labor market data, everything appears to be late cycle. The only real large category that's not late cycle is housing, and that's because housing didn't actually start to recover for almost 3 full years after everything else. So the broader market is now going into its 7th year of expansion. Housing's more like in its 3rd or 4th. So that's an area where we think people are going to be rewarded on the long side over the longer term.
Okay, great. Yeah, let's shoot to the queue here, and Wes. We have a good list of questions. First one, lately some people are arguing that an interest rate increase will actually boost lending because banks will be motivated to finally start earning interest on their loans. Is this clutching an unrealistic hope, or is there a sweet spot at a higher level that could actually boost credit expansion?
Yeah, so this is a great myth. A lot of people sort of put this out there, not the least of whom are the banks themselves. So the reality is that if rates were to go up at the short end, it would be good for banks because they would actually get a little bit of tailwind on their net interest margin. The flip side, however, is that it is very unlikely to actually prompt demand. And the reason for that is the misconception is not that banks don't lend money because rates are low. It's that consumers don't want to borrow, nor do institutions. There's tons of money out there. There's credit available for anyone who wants credit, provided you're above some minimum threshold from a credit worthiness standpoint. But the reality is that it's not the willingness, it's the demand. So, it would be good for banks on the margin because, right now they're basically stuck. They have, cut deposits as low as they can go, and that's been the case now for almost 2.5, 3 years. So they have no more ability to take down their liability costs. And on the asset side, they just continue to get squeezed. So, and most of a bank's balance sheet is priced off the short end. And so if you take short-term rates up, that will actually help them on the asset side. And then they're not going anywhere on the liability side for quite a long time.
Right.
So.
Okay. Next one, mortgage purchase apps missed on the week. Is this a head fake or are you still bullish?
Yeah. So there's a couple data series that are, so-called high-frequency data, meaning they come out a lot. One's initial jobless claims. We got it this morning. It comes out weekly. One's mortgage applications data from the MBA, Mortgage Bankers Association, also comes out weekly. The good thing about high-frequency data is that you really have your finger on the pulse of what's going on in almost real time. The bad thing about it is, as is the case with any high frequency series, it's subject to an enormous amount of volatility.
Week to week. And,
Oh yeah.
It's more about the trend and the data than
so look, if you get, the way most people look at it is they'll sort of look at a rolling average, right? Anywhere from 2 to 5 weeks. The value in high frequency data is when you get a print that is very anomalous, either really good, really bad, you don't want to take it on face value, but what you do want to do is pay attention to it, and more importantly, pay attention to the next print to see whether it's confirmation or whether it was just an outlier print.
Yeah.
So on Wednesday, we got MBA purchase data that showed that applications were down 3% to purchase homes on a week-over-week basis. So on its face, that's a little bit weak. 3% is not an enormous number. What I take comfort in is that even though it was down 3% week over week, it's actually still up 14% year over year. And the quarter as a whole is still trending up almost 18% sequentially versus the first quarter. So that data set is still very strong. It was a weak print. It's a single week, so I'm not going to get overly excited about it.
Mm-hmm. Okay, let's do 2 more questions here. What is the best metric to use in determining how much credit is available to quality borrowers?
Well, there's a lot of different ways you can look at that. Again, one way is to look at the Senior Loan Officer Survey. Generally, what you see, like bank lending is very pro-cyclical, right? And banks are notoriously always fighting the last war. So what was the major asset class of destruction in the last go-around? It was mortgages, right? So mortgage underwriting standards since the crisis have been extremely tight, and they remain tight. But one of the tenets of our bull case on housing is that actually, finally, they're starting to loosen back up a little bit. So that's good. In other areas, things like C&I and commercial real estate and auto finance and credit card, for the most part, credit is pretty available at this point. It's extremely available in auto finance, probably too available. Credit card is pretty middle of the road. You're starting to see some operators kind of wade into the deeper end of the pool at this point, going more into the subprime borrower than they have been, say, over the last 3 to 4 years. On commercial real estate and C&I lending, C&I actually performed extremely well through the downturn, so that was one of the few areas where banks have been lending pretty aggressively all along, and no change there. Commercial real estate, they got burned pretty badly, so they were cautious, but now again they're starting to ease up on that a bit. I think over the next couple years, notwithstanding a cycle turn, what would be very interesting to see would be whether you can get back to a point where, I think of underwriting as this sort of pendulum that swings back and forth, right? Things are almost never where they should be, right in the middle. It's either too loose, standards are too loose, or too tight. Mm-hmm. And what I'd like to see over the next 2 to 3 years, particularly on the mortgage side, because it's such a large asset class, would be at least for the pendulum to get back to center. If we can get that, then it'll fix a lot of problems.
Okay. I guess one more from subscriber, then I'll ask one. Hi, Josh. What do you think is this is a loaded question, what do you think is the single biggest risk to U.S. equities right now? That's not,
well, I mean, it may not be an obvious answer, but I'll go with it anyway. It's valuation. If you look, there's a really good paper that was written by a guy by the name of Cliff Asness at the hedge fund AQR. And, self-made billionaire, extremely good quant analyst in looking at markets and different asset classes over time. And he writes a ton. You should check out a lot of what he's written. Anyway, one of the papers he wrote a number of years ago was a look at what he calls our old friend, the Shiller CAPE ratio. So just about everybody's familiar with the simple concept of the PE ratio, price to earnings, as sort of a general referendum on, how rich is a stock's price relative to the underlying earnings power. So the step that the Shiller PE takes is it says, well, earnings are inherently pro-cyclical, right? When you're at or near the top of the cycle, earnings power is going to be a lot greater than it is at the bottom of the cycle. So instead of looking at PE on a single snapshot basis, meaning 1 year, the better way to do it is to look at the trailing 10 years worth of earnings relative to the current price. So Shiller's got data that goes back, I believe, to 1890. And what Cliff Asness did is he looked at the subsequent 10 years of return in the market, depending on where you started out at that moment in time on a Shiller PE ratio. And what he found is that if you break those starting points into deciles, meaning you're in the 10th decile, the most overvalued, the bottom decile, the most undervalued, and so forth, the subsequent returns were exactly the same as what your starting multiple was, meaning the higher the multiple, the lower the return. And they're monotonic, meaning...
Oh, they were, okay. The returns were reversed, basically.
Right.
Okay.
So the higher your starting Shiller PE multiple, the lower your subsequent 10-year return. And what he found, actually, is that...
It seems like a very simple concept.
It is, but you'd be surprised how little simple counts for.
Yeah.
And the point is that when you're in your top decile of valuation, your subsequent 10-year return is around 0. And for 10 years.
Yeah.
And what's interesting is that the cutoff point for that Shiller PE ratio is a multiple of right around 24 or 25 times. And right now we're at 27.
Oh, wow.
So we're solidly into that 10th decile, which based on the last 125 years worth of data suggests that the subsequent 10-year return will be 0. So that is, without a doubt, the single biggest risk to the equity markets is that you've got over a century's worth of data to show that the returns over the next 10 years are going to be terrible.
Yeah, wow.
Which is one of the reasons why, in my opinion, a buy and hold strategy over the next 10 years is going to do terribly, right? So, the proper way to think about it is, there's always going to be spots where you can make money. We're going to do our best to help you sidestep things that are going to obviously not do well. But, if you just sit parked in equities for the next 10 years, you're not going to make any money. That's just a fact.
Right. And then I guess the last question, you mentioned how housing just hasn't really seen the recovery that other areas have. We had this call on Monday with the chief economist at NAHB, and he kind of separated, housing is very interest rate sensitive, he kind of separated some of the positives in housing away from moves in interest rates. What do you see there?
Yeah, I think a lot of what he had to say about sort of the broader state of housing is pretty consistent with how we've looked at it as well. For instance, in a normalized housing environment, the level of construction is around 1.3 million starts per year. Right now, that's single family starts. Right now, we're actually running at half of that. So, and that's even though we've been getting better each year for the last 5 years. We're still only at halfway back to normal, not prior peak, normal. So, if you have a large investable asset class, when everything else is late cycle, Keith likes to say a lot that when there's not a lot of growth, people will pay more for the growth that's there.
Yeah.
And that's sort of our philosophy is everything else is very late cycle. Housing is at best mid-cycle, and I don't even think you can say it's mid-cycle because we're at half of normal levels of construction. So by definition, that would actually argue for it being still early cycle. There's a lot of growth left in housing. It's a very durable investment, meaning that you can look at that from a 5-year or more perspective. And unlike the broader market, which I just outlined as having a prospect that's terrible, the outlook for housing is really good.